And welcome to HCR Wealth's Navigating the COVID Crisis conference call. All lines have been placed on a listen-only mode, and the floor will be open for your questions and comments following the presentation. At this time, it is my pleasure to turn the floor over to your host for today, Mr. Jordan Kahn, Chief Investment Officer for HCR Wealth. Sir, the floor is yours.
Thank you, operator, and thank you, everybody, for dialing in today to our webinar on navigating the COVID crisis. Obviously, there's a lot of things that we could discuss, particularly as it pertains to the health aspect of this. But for our purposes today, we're going to try to really focus on the market's perspective on what's going on. Okay, so with that, let's get into it. Some of the data points that the market is really focusing on, first and foremost, we would say is watching for a peak in the number of cases. So over the weekend, we saw that Italy and Spain were reporting that they had possibly seen a peak in cases. We came in on Monday mornings and the market had a really, really strong rally. The Dow was up 1,000 points. This week, there's been some chatter. Dr. Fauci weighed in and some other people saying that we could be nearing a peak in cases in places like New York, and we've seen continued strength in the market from that. So obviously, the market seems to be very sensitive to watching for this kind of peak in cases and what they're calling a flattening of the curve. It still remains to be seen once we do see the peak, what the other side of it looks like. Do we start to see a consistent decrease, or is it going to kind of level off and plateau? So that's something to watch as well. Also, the market's watching for a ramp up in testing. One of the reasons that places like Germany and South Korea have seen lower mortality rates than we have is that they've done so much more testing. And so one of the things that we need to see here is just a ramp up in the number of tests that are getting done. I know that there's currently a large backlog at some of the clinics, so we need to see that clear up and just be able to test more people. Also, to get a test developed that can test for antibodies, right? So people that have been exposed to the virus or that have already had it, have they developed these antibodies or some sort of immune response that would make it more likely that they could go, back to their normal lives or back to work, if you will. Third thing is seasonal weather patterns. So one of the things that we know from past viruses, things like the flu and other coronavirus or corona-like viruses, is that when the weather starts to get warmer, these things often dissipate. So, it remains to be seen how this novel coronavirus, if it will have that same sort of seasonal pattern. So as the weather continues to warm up here in the Northern Hemisphere, that's another thing that markets will be paying attention to. And the last, but also another really important one is progress on both an antiviral as well as a vaccine. So the antiviral or a therapeutic is very important just for the number of people that seem to get really sick from this virus, right? I mean, there's a lot of people that have mild symptoms, but there's also a lot of people that get very sick and have to go in the hospital and get on ventilators. So having an effective antiviral or a therapeutic will obviously ease the strain on the healthcare system, which was one of the big concerns going into this and one of the first reasons why the governments decided to do the shutdown. And also developing an effective vaccine so that we don't have recurrences of this at later periods. The FDA and other professionals have said that the earliest that one can likely expect to see a vaccine is probably 12 to 18 months. So even if we take the shorter end of that time frame and say that the firms that are working on it or the companies that are working on this started maybe as early as February, it's likely that we probably won't have one until early next year at best. But those are all things that markets and investors will be watching for. Okay, a question that we often get asked is, are we in a bear market? Technically, the answer is yes, right? I mean, if you look at the standard definition where people say if one of the major indexes is down 20%, that qualifies as a bear market, then the answer is yes. One thing I would say is that's kind of more of a popular definition. Historically, a more true definition for a bear market has been a persistent decline in the general level of asset prices and economic activity. So By that definition, we're probably still in a bear market, even though a lot of the data hasn't even come out yet because we're just in the early stages. But just being able to slap the bear market label onto this environment, doesn't really do everybody a whole lot of good. So one of the things that we did was we wanted to go back and study all of the past bear markets and try to get a sense of what was the average magnitude and duration. So what was the average peak to trough declines that these periods saw, as well as the duration of these periods, how long did they last? And then most importantly, when do we start to add back the stocks? When is it okay for investors to begin to dip their toes again? So I went and looked at several studies that went back as far as 100 years. This one that I'm currently putting on the screen right now is done by a firm called Hedgeye Research. They went back 100 years, and I know that these numbers on the screen are kind of small, but if you can see by my pointer, what it shows in this column that's labeled duration is that the average bear market going back 100 years lasted about 20 months. Okay? Now this includes the period of the Great Depression also. If we were to exclude that, which a lot of studies do because markets just simply weren't anywhere near the same as they are these days, but even if we went back and looked at, let's call it the post-war period, which still encompasses 75 years, the average bear market in the post-war era was about 12 to 18 months. Okay, and then the next column shows the average peak to trough drawdown in the S&P 500, and that is about 39% according to the study. So what we can kind of glean from those two is that in terms of duration, we're still early in what the average period looks like, but in terms of the magnitude of this thing, it's possible that we've already seen the bulk of the declines because in February and March we saw such a sharp decline in the market. So let's go back and look at some past bear markets and the action that the indexes displayed during those periods. We think that this is helpful for investors to just kind of get a sense of how long these things last and what the general patterns are that usually play out. So what I did here was I went back about 50 years and tried to find examples of markets that experienced large declines and kind of how long they took to bottom. So we're going to go through some of them right now. This one on the screen is the 1973-74 bear market. What was going on during that time period was we had the OPEC oil embargo that was causing long lines at the gas stations. There was also a recession that was underway, and as well we were in the midst of the Watergate scandal and all of the hearings that ultimately led to Nixon resigning. So what you can see here on the screen is that markets peaked here at the end of 72. They had this first wave down into the fall of 73, enjoyed a pretty sharp relief rally, then they came back down and made new lows, chopped around there for about 5 or 6 months, and then broke down even further as we got into the end of 74, ultimately bottoming around late September 1974. We had a little bounce and then another retest. And so this period, you made this initial bottom here, and then you had a bounce and a retest. That took about 2.5 months before you got that retest where the market held at the previous lows, and then a new bull market started from there. This is the example of 1987. Obviously, investors will remember 87 is the year of the crash. That's this large gap that you can see here. So markets were starting to weaken in the fall of 87. Once we got into October, markets had this big crash here. They bottomed about a week later. Market experienced almost a 20% relief rally, but from there, things kind of petered out and the market stalled. And as we got into December, the markets retraced those gains and tested the lows from early October. So here we see another example of the retest. In this case, markets didn't make a lower low. They held at these levels and then resumed from there. And again, this took about 2 months from when we made this initial low to when we retested those lows. Here is 1998. What was going on back then? In 1997, there was a currency crisis that started in Asia. It had, by 1998, it had, worked its way around other parts of the globe. And in the summer of 98, Russia came under significant pressure, which ultimately forced them to devalue the ruble and default on some of their debt, which kind of sent shockwaves through the financial markets. And that's where you see, after Russia defaulted on its debt, even though markets were already coming down, you see this sharp sell-off in August of 1998. Markets bottomed and experienced a 20% relief rally, chopped around there for a little bit, came back down in October, wound up making a lower low in October. The Fed did some emergency rate cuts in October of 98, and then a new bull market resumed from there. Next example is 2001. Investors will remember in 2001, this was the post-tech bubble period. So markets were slowly starting to weaken in the summer of 2001 as the economic slowdown and things were starting to get priced in. In the fall, the slowdown began to accelerate, or the declines started to accelerate a little bit, and this is when 9/11 occurred. So we had 9/11, markets reopened after 9/11 and really experienced this sharp decline after reopening, bottoming a couple weeks after 9/11. And then from there, markets went on and had this about 24, almost 25% relief rally that couldn't get much further than that. So that was kind of the top for 2001. And as we got into 2002, markets continued to chop around. By the summer of 2002, they started to weaken again. And you can see they broke down below the lows from 2001 and had another big sharp drawdown in the summer of 2002. From there was a 24% relief rally, came back down and retested those lows again. The period of time from these July lows to October was about 3 months. After the October lows, we had another 24% relief rally. But then again, markets couldn't make much headway, kind of chopped around. And then in the lead up in early 2003, that was kind of the lead up to the second Gulf War. So markets kind of traded back down again, wound up making a higher low versus October. And then in early 2003, that's when the new bull market started. Last example is 2008. Investors will remember 2008 probably a little better. In the spring of 2008, that was when Bear Stearns first went under. That kind of started the whole wave of financial distress. Markets actually bounced pretty well after Bear Stearns went under, but by the summer of 2008, things started weakening again. That's when Washington Mutual went under, Fannie and Freddie had to be nationalized, and then culminating in September of 2008, when Lehman Brothers declared bankruptcy, that's where you can see this really sharp decline when things kind of accelerated on the downside. They bottomed in October of 2008 when Congress passed the TARP bill. That led to a 20% relief rally. But from there, markets came back down and made a lower low in November of 2008. Had another, this time 27% relief rally that couldn't hold, and again faded into the ultimate March of 2009 low before the next bull market started. So that in the time period between this March low and this secondary low in November was again about 4 months. So those are examples of how different markets played out and how much time it took between when the markets made their initial low and then had some sort of retest. If we look at how that compares to today's market, we see here that markets started to break down in late February. This decline really accelerated quickly into March, and so we had a 35% decline from peak to trough. And then since then, we've had about a 25% relief rally. So a pretty big relief rally. In terms of the magnitude of the decline, that's pretty consistent with what we've seen in other severe down periods. But this 25% rally on this side, the problem here is it's only been about 2.5 weeks since this initial low. So it's really too early to say in any definitive sense that that one can call the bottom. As you've seen in all the past examples that we just showed, selling during these time periods usually occurs in waves. And so the prudent course of action is really for investors to be patient more than anything else, while these things kind of play out. To help investors get through this period and to help our clients, we have made a series of defensive moves in client portfolios. So we have raised cash, we have trimmed our exposure to equities or stocks, and we've also bought defensive positions in client portfolios. And all of these moves are meant to manage risk as we're getting through this period, and also to minimize the volatility in clients' accounts so that they can, kind of get through this period and be intact on the other side of it when we start to dip our toes back in and reallocate back to growth. Okay, so when we talk about, looking for a bottom and reallocating back to growth, one of the questions that we're often presented with is, isn't it different this time? And the answer, of course, is yes, right? This is obviously a very different time period. We've never seen this sort of national quarantine where the government just shuts down all of the businesses across the country. But what I would say is that, the news backdrop and the headlines, those things are always kind of different. I mean, in '73, nobody had seen, an oil embargo that threatened to shut down our then mostly manufacturer-based economy. In '87, nobody had seen a crash that resulted in a 22% one-day decline. 9/11, right? Nobody had seen a terrorist attack on our soil that kind of threatened to permanently disrupt the way that we lived our lives. So the background and the events of the time are always different, but what tends to be similar and has patterns that are fairly repeatable are the emotional cycle that investors go through, what we kind of call this fear and greed cycle. And there's kind of a simple chart of it that you can see on the screen. And what happens during bull markets is investors' optimism and excitement continues to grow the longer that the bull markets persist, usually culminating in a period of euphoria that often coincides right around the time that a bull market peaks. Once the market starts to decline, investors start going through these other emotions, right? In the beginning, it's just denial, then it kind of morphs into fear and eventually panic. I think that when we look at the declines that we saw in March and we look at kind of the panic liquidation that spread across all asset classes, it wasn't just stocks that were selling off hard. We saw it get into bonds and other safe investments. So there was really a wholesale liquidation that kind of sparks of this panic phase. So I think that we've definitely qualified and seen that, but what we haven't yet seen is this kind of final stage. On this slide they call it despondency. We sometimes call it like the give-up phase. And that's really where investors, because of these conditions persisting for an extended period of time, investors just kind of lose enthusiasm for the market and kind of, like I said, kind of give up. And so I can recall in early '03 and early '09, both times when we decided that things looked like they were bottoming out and it was time to start taking some of our cash and some of our defensive investments and reallocating back to growth, we got a lot of pushback from investors because it was hard for them to see how things just didn't continue down and keep going in the same direction. So that's something that we need to continue to be mindful about because I don't yet think that we've seen that phase. So as we talk about kind of this trough period that we need to get through, what are the things that the market will be looking for? Obviously, as I mentioned, this was a unique slowdown in the sense that most slowdowns and recessions kind of take some time to unfold. Things begin to slow down, corporations cut back, they start to lay off employees, and these things kind of build on themselves. In this case, it was really kind of an overnight thing, right, where the government just flipped a switch and induced this shutdown by shutting down businesses and ordering people to stay at home. So, but we also know that the government is eager to start transitioning from this stay-at-home phase that's currently in place to get to some sort of back-to-work semblance of order. And so we don't yet know exactly how that's going to work. Maybe it's going to go in stages, but the market will definitely be paying attention to how that goes, this whole back-to-work phase. In the interim, one of the things that we've seen is, the government really step up and provide a lot of aid. One of the more popular programs that we've heard about in the last couple of weeks are these SBA loans that are being rolled out. So it's $350 billion carve out from a total of a $2 trillion stimulus that's designated for small businesses. And what it's really intended for is to bridge this gap, right? So the government shut down all these businesses. There's no revenues coming in. So the government needs to provide some sort of Band-Aid to bridge that gap and help companies stay solvent so that, when the switch gets flipped the other way, that companies are still in business and they can get back to work. One of the things that's a little bit different about all of these programs that are being instituted now compared with 2008, there's a couple of things. In the great financial crisis, it really took a long time for Congress to get together and pass some of these bills, right? I mean, TARP wasn't passed until 2008, and the first time the bill came to the floor, it failed because there was so much disagreement on it. This time around, there's no real bad guys. This shutdown and this recession wasn't because of any corporate malfeasance or anything that any, companies or sectors did wrong. This was, a health concern. It was created by this virus, and the government decided it was necessary to shut things down in order to kind of get their arms around the situation. So these bills that have been passed recently, they were passed in the first month of the shutdown, which is kind of unprecedented, but I think it's good to see that there has been sort of this nonpartisan agreement from Congress, and I think that, as we continue to see how the economy unfolds, there's likely going to be a need for more stimulus and more aid, and so it's a good sign that early on that Congress has been willing to kind of pass these things. So everybody seems to be on the same page there. We've also seen a record amount of global stimulus. So I mentioned here in the U.S. the fiscal stimulus plan of $2 trillion. That's about 10% of our GDP, so that's a big number. If you include all of the monetary stimulus that the Federal Reserve is embarking on and has also proposed, I mean, you get numbers that are upwards of 25% of our GDP. So those are just enormous numbers. And one of the firms we work with, BTIG, they went and looked at every single country that has announced both fiscal and monetary stimulus measures and added them all up. They came up with, across the globe, about $14 trillion worth of stimulus, which on a total world GDP basis accounts for about 15% of world GDP. So those are really, really big numbers. I mean, bigger than even something like the Marshall Plan, which was the effort after World War II to rebuild Europe and put things back together. So you have a huge amount of stimulus that's out there and being put into the system. As we know from past periods when stimulus has been enacted, it doesn't work immediately, right? But it does kind of help set the floor, and when the economy regains its footings and markets start to turn higher, all that stimulus provides a nice tailwind for the recovery. So I think we will see that kind of kick in at some point in the not too distant future. So in summary, investors should be prepared. The economic data is likely to continue to worsen. We've only just begun to see unemployment figures start to go up. We saw a large spike in jobless claims recently. That's likely to continue. We're also going to see sharp downward revisions to GDP growth. And also, corporate earnings season is just getting started here. In a week or so, we're going to get into Q1 earnings season. And so we're probably going to see large downward revisions to corporate profits as well. And that's something that obviously the market will be focused on because ultimately, stocks are priced off of corporate earnings. So we need to see where are corporate earnings going to settle in. A lot of companies have suspended their guidance. So we need to hear more as management speak on their conference calls. Are they going to continue to do buybacks and dividends or need to cut those also? So there's a lot of moving pieces that we'll be listening for as we get into earnings season. We also need to continue to monitor those COVID data points that I mentioned at the beginning. So looking for a peak in cases, a ramp up in testing, any seasonal weather patterns that might emerge, and also any progress on the antiviral/vaccine front. If there's one takeaway that I hope investors got from this webinar today, it's that market bottoms are a process, right? They take time to work themselves out, and so successful investors are ones who can exercise patience and get through this. And so hopefully we've laid the groundwork for all of you so that you kind of understand our thinking as we work through this, and how, for the most part, we've made some moves to get more defensive to kind of ride this out, but we also just need to exercise patience and wait for a better opportunity to start dipping our toes back in. And with that, I'll turn the call back over to the operator for our Q&A.
Thank you. Ladies and gentlemen, if you did have a question or comment, it is *1 on your telephone keypad at this time. If you're using a speakerphone, we ask that while posing your question, you pick up your handset to provide the best sound quality. Once again, it was *1 for any questions or comments at this time. Once again, *1 for any questions. We'll go first to Michael Morgan.
Yes, thank you. I'd like to know specifically what plans the firm has in place, both short-term and long-term, during this crisis, and what do you recommend specifically for individual investors?
So, it's hard to answer that question with great specificity, because all of our investors kind of have different risk tolerances and different portfolios. What I can say broadly is that for all of our clients, regardless of what their personal risk tolerances are and investment objectives, what we've done is moved to the lower end of their respective risk spectrums. So we've done what we can to get more conservative in the portfolios to minimize volatility and help our clients kind of ride things out during this period, so that ultimately when we think we've seen signs that the dust is starting to settle, then we can start adding back to the growth side of the equation. Our goal, if we're successful doing that, is to minimize the declines during this period, and if we do a good job of that, we know from experience that when we start to allocate back to growth on the other side of this, that we'll be able to make back those declines in fairly short order.
We'll go next to Diana Elkins.
Hi, Jordan. I have read that if people don't get back to work by May 1st, the economists are predicting a depression. We're in a recession, but a real depression. So what happens to our portfolios if we are going to go into a depression, which I, for one, have never been through? So what do you think?
Yeah. Hi, Diana. I think given the unprecedented amount of support that the government has said that they're willing to provide for this, I think the implication there is, that if you're in for a couple trillion to kind of support the economy and support businesses getting through that there really isn't a limit to how much that they will provide to avoid another depression. So that's kind of my first take on your question. But I think to answer the second part of it and to ease your concerns, the answer would be, if this was going to be much deeper and longer than we anticipated, we would continue to make more moves to get even more defensive and insulated, to be able to ride it out for a longer period.
And at what period of time would that happen? Like, how much longer can people go without working and the economy is stopped, not even slowed down, just stopped, before people go back to work? I mean, they're predicting a long time before things are going to ever get back to normal. So what period of time are you looking at where things could really go bad?
Well, I mean, it's hard to say at this point. Right now, I think that the governments are looking at, getting people back to work in some sort of stages, right? And so there may be some parts of the economy that, like you said, do never get back to normal. But there are companies that are still operating during this, and I think that, even if we get back to work in stages, then I think markets will be able to figure out, or at least try to quantify, well, what does this kind of new paradigm look like, you know, and be able to do a better job of pricing things in.
Okay, so what I'm getting from this conference is everyone just hope, be quiet, and just be patient. Is that basically what you're saying? We don't know where we're going, and we just have to wait this out.
Well, you know, what markets hate more than anything is periods of uncertainty. And so that's what we saw in the beginning stages of this, right, is that nobody really knew what was going on or how long it was going to last. Now that's one of the reasons why I mentioned why we're focusing on the caseload and if things are starting to peak and turn down with the testing and everything so that we can get some segments back to work. And we're not saying that everybody should just sit there and do nothing. We've made considerable moves in portfolios to get more defensive, you know, to be able to ride this out.
One final reminder from the phone lines, it was *1 for a question or comment. We'll go next to Kathleen Sane.
Hi, thank you. Hi, Jordan. Question for you. I was in the process of purchasing a home and was still trying to do that. I'm just curious on your take when it comes to mortgage rates and just California real estate in general.
So, you know, there's a couple things that I would say there. You know, one is because of this shutdown and everything, you know, I think that if you were looking to purchase a home, values are probably going to change on the other side of this, right? Because we don't know, there's probably going to be less activity when things restart. You know, there might be more vacancies and things like that. In terms of mortgage rates, you know, the Fed has already cut rates down to 0, and we've seen the 10-year Treasury yield get below 1%. So mortgages should be pretty cheap. You know, if you can get one, I think that probably will be a little bit harder for some people to qualify. But mortgage financing should definitely have been cheaper. And what was the third part of your question?
Well, I guess just when weighing out how this is going to affect mortgage rates and, you know, if you buy now or if you lease and buy in a year, you know, I guess that's my major question.
Yeah, I mean, you know, typically what we've seen in like the past recession was that Los Angeles real estate didn't go down quite as much as some other parts of the country. You know, one is there's a little bit less new supply here in general. There's also usually more cash that's sitting on the sidelines and waiting to come into a market like ours. But bigger picture, there's likely to be downward pressure on home prices, right? There's going to be people that either want to downsize, and maybe people that are out of work. And so I think, you know, your best bet when you're looking to purchase is just to kind of extend your time frame and not be in too big of a rush.
Okay. All right. Thank you.
Mm-hmm.
And Mr. Kahn, at this time, I have no other questions holding from the phone lines.
Okay, great. Well, thank you, everybody, for dialing in today. If you think of any other questions, you know, feel free to email your advisor, and we will make sure to get them all answered. Okay? Thank you.
Ladies and gentlemen, that will conclude today's program. We thank you for your participation. You may disconnect at this time, and have a great day.